Hi, this is Elliot Eisenberg of Graphs and Laughs, catching you up to date on the latest in residential sales data in both Hillsborough and Pasco counties. And what we have here is a situation of two counties that are really behaving as one market. No matter how you look at it, the behavior in sales data, pending sales data, inventory, and price data is essentially the same in both counties. Pending sales are very strong in both cases, stronger in multifam than single fam. Sales data, strong in both, stronger in both in multifam than in single fam. Sale prices are going up by about the same in both counties, mid to upper teens for both single and multi. And inventory, the single most important variable I want you to focus on as we go forward, is tiny in both. There's 0.6 of a month for single fam and 0.8 of a month for multifam in Pasco County. In Hillsborough County, it's 0.7 of a month for both. Is that difference? Is there a difference? Yes. Does it really matter? Absolutely not. Nationally, inventory is 2 months. Inventory in these two counties is a third what it is nationally. What's incredible is that despite the fact that inventories are plumbing new historic all-time lows, sales activity remains very strong. Now, sales activity is going up much faster in the multifam side than the single fam side, as I mentioned earlier, in both counties, because there's simply nothing to buy on the single fam side. So even though there's nothing much to buy on the multifam side, people are saying, well, at least I better look at what there is everywhere in the hopes of getting something that I like. And what's impressive is that despite this lack of inventory, there's no real decline in sales activity. It's continuing to grow at a very healthy pace. And prices, they're up across the board in both counties by about the same for both single and multi, upper teens. These are very, very strong numbers. What we really need is more inventory. If you know someone who's thinking about selling their house, convince them to do it. It's in their best interests and yours. I'm not kidding. The other thing I want to talk about now is I want to change focus and talk about nationally what's going on. Q1 turned out to have been a great quarter, much better than economists thought. Over the course of the entire quarter, and since the quarter's ended and more data has come out, expectations for Q1 have continued to improve. It will have seen 6.5% growth in Q1, really great number. In Q2 and Q3, it'll be even better. Injection rates are higher. There's more pent-up savings in the trillions nationally, but it keeps growing. That's going to begin to get released. There was stimulus money checks that came out. Government closures nationally are ending. In most cases, mask requirements are declining and so on. People are feeling happy, they're feeling enthusiastic, they're spending and they're doing things. Q2 and Q3 will be the best quarters of this year, quite possibly above 8% growth in each quarter. Q4 will be a little bit less, but still very strong, probably 6.5 like Q1. Q1, Q2, and Q3 up here, and Q4 a little lower. Now, let's talk about interest rates. I think interest rates are going to rise because markets are going to get a little spooked. And they're going to be nervous because inflation numbers are going up. But I'm not convinced this is a real reason to be concerned. That said, markets do what markets do, and I think they're going to latch on to the higher inflation. That's going to cause the 10-year to rise, which will cause the 30-year mortgage to rise. Let me explain. There are two types of inflation that we're going to experience. We're going to see inflation compared to last year when gasoline prices were very low and restaurant prices were low and airplane tickets and hotel prices were low. Now, compared to last year, they're much higher. They're not really high now, but they're much higher than they were a year ago. That's called a base effect. The year ago number was really low. The second type of inflation that we're going to be seeing is bottlenecks. Go to a store. You want to buy some electronic goods, maybe a laptop, maybe a washer, maybe a dryer, a refrigerator. Prices are high. You want to hire a repairman to fix something or a home builder to build something. They'll tell you it's 6 months away, and they're raising prices as a result. That's a bottleneck that we're experiencing. These bottlenecks will go away. Ships will be traveling. Assembly lines will be producing more washers and dryers, and it will go away. Now, the market's not thoroughly convinced, and they fear that these bottlenecks may turn into permanent rises annually in inflation. We won't get the better of these bottleneck problems. I'm thoroughly not convinced of that at all, and I think these inflation numbers will all peter out by the end of the year. But between now and then, it wouldn't surprise me at all if rates were to rise by about 0.5%. In the meantime, enjoy the low rates, enjoy the strong buyer demand, and do your best to increase the supply of housing. That's it for now. See you next month.